Good afternoon from the For the See Me. This is Chris Robinson with your Traders Exclusive comment for today, Thursday, December 20th. Merry Christmas to everybody. We're going to talk about what has not been a very merry day in a lot of the markets. Today, Thursday, I'm not going to talk about the stock indexes other than to say watch the percentages. The NASDAQ, we've had a 20% pullback. The S&P and Dow are over 16%, roughly, give or take. And so we'll see if the 20% level is some sort of a target for the S&P or the Dow. It has had some ramifications, some overflow into the rest of the markets. I'm going to talk about the grains here, specifically soybeans and corn. And I want to focus in today on the importance of gaps on a trading chart. The night of the G20 summit, both corn and soybeans gapped higher. That means we settled at a certain price, and then the next time they turned the machines back on or opened up trading, we didn't even have any prices, a certain trades at all, and a gap. A gap, I think the gap in the soybeans was about 6 or 7 or 8 cents. It was about 3 or 4 cents in the corn, give or take. You can look at those on a daily chart, pull up March beans and also pull up March corn. Something happened though over the past 2.5 weeks or so. We never got any follow through, and the market held in there pretty good. You had a lot of people actually start to buy corn and certainly buy a lot of soybeans in anticipation of resumption of normal trade with China, right? So there's a logical idea. Oh, we got good news, you gotta get long, and then what happens? There's no follow through. And in the past 3, 4, 5 days here, soybeans have now given back a huge chunk of their rally. If you go back to the contract low and the highs that we made after the announcement that the G20 summit, we were going to resume some trade with China, it was a dollar rally. So we've come back now, and those gaps which had been signs of strength, those gaps have all been filled today. So what is that? Well, that's typically people that bought the highs after the headlines were out, and they have now been stopped out. So you saw soybeans break 36 cents. You say, well, what does that mean to the average person? Well, it's give or take $1,500, maybe $1,800 on one contract. So if you bought soybeans and you were holding on to them, a lot of people kind of threw the towel in today. And we'll see, is that a capitulation low? I don't know. Is it some sort of combination of the fact that we've had downward pressure in the stock market? You throw that all into a ball of wax. The one thing it does give you is movement. And if you're a day trader or if you're a speculator, movement is what you want. And now if you're a producer or farmer, you really don't want movement so much, as long as that movement's, if the movement's higher, it's great. But this is a perfect example of why, if you're a producer, if you're someone who's always long market, you're growing corn or wheat or soybeans, you always own soybeans. You own all the soybeans that you've got in the bin, all the corn you have in the bin, all the wheat you have in the bin. Plus, really, if you think about it, you're long all of the bushels of corn, wheat, and beans that you're going to plant for the whole time that you're going to continue to be a farmer. So if that's 5 years, 20 years, 40 years, depending on how old you are, you're always long that grain. So the past 2 weeks has been a perfect test case, really, of why you need to be kind of quick on your feet and protecting rallies. We had a dollar rally in soybeans. We've given back 36 cents of that. For goodness sakes, you don't want to lose another 35, 40 cents if we were to fall out of bed again on some headline news that wasn't good. So that's why, as a producer, you always need to have some sort of a hedge, some sort of a hedging program. If you're a speculator, it's easy. You're long, get out. There's no two ways about it. But if you're a producer, you're really always long. So you need to manage your risk on paper. You do that 2 ways. You either have to have futures on against your position, or you have options on against your position. Those are the 2 ways to hedge. So that's really what I wanted to talk about today, is the fact that it can be very dangerous to get emotional about headlines, and you can see how the market can give back what were decent profits. You see it slide away. And a lot of it doesn't have to do with anything really rational. Sometimes the market just gets very irrational, and you've seen that here in the past 5, 6, 7 days. We are heading into the end of the year. A lot of people are not going to even be trading. So between now and the first of the year, second of the year, I'd say you probably continue to see very thin and choppy markets. If you're looking for something to do and you don't have anything on the books right now, I would almost say wait till the first of the year. There'll be plenty of time, January, February, March, to get back in the game. So that's on that note. I want to wish you all happy holidays, Merry Christmas. If you're looking for help with your hedging or you're speculating, look me up online, Chris Robinson.